A quiet Sunday morning settles over Nicosia. Yet outside shuttered bank branches, the stillness fractures into scattered conversations that carry the same question without resolution. ATM screens display withdrawal limits that appeared overnight. And depositors, who expected inconvenience, begin to recognize a change in status they cannot yet describe. What unfolds in that moment is not the collapse of a bank, but the reinterpretation of a relationship that once felt simple. Balances remain visible on mobile apps, which makes the restriction feel temporary, although the restriction itself marks the first procedural step in something more structural. Across jurisdictions and crises, similar scenes recur with minor variations, suggesting a pattern that does not rely on panic so much as administrative timing. During the Cyprus banking crisis of 2013, announcements arrived between market closures and reopenings, leaving depositors suspended in a weekend interval that functioned as both buffer and containment. That timing reflects an operational reality rather than conspiracy, because resolution frameworks depend on moments when claims cannot be instantly mobilized. Present conditions carry the same architecture, even where stress remains invisible, since post-crisis regulations have quietly embedded bail-in capacity into banking law. This investigation follows a narrow question that tends to disappear beneath technical language. What actually happens to deposits when a bail-in activates? And how does a claim that felt liquid become a tool of stabilization without explicit consent? The answer does not rest in dramatic seizure, but in a gradual relabeling that unfolds through accounting entries, legal hierarchies, and behavioral containment. A mental model clarifies the transition without requiring balance sheet expertise. Imagine a damaged vessel distributing life jackets to passengers, only to discover that the jackets must also plug holes in the hull, forcing a lottery that prioritizes structural survival over individual certainty. The image captures the tension between personal property and systemic continuity. Although the analogy remains imperfect because financial systems operate through contracts rather than physical scarcity, depositors rarely consider their position within that structure. Largely because everyday banking masks the contractual nature of deposits behind user interfaces and deposit insurance narratives. Historically, banks have treated deposits as funding sources rather than stored assets, a reality visible in the Soviet Union's final years when savings accounts lost real value despite nominal stability. That episode involved inflationary erosion rather than formal bail-in mechanics, yet it revealed how depositors' claims depend on institutional solvency rather than physical reserves. Modern parallels appear in environments where liquidity promises persist while access becomes conditional. As seen in Lebanon's banking restrictions beginning in 2019, still inflationary collapse and bail-ins operate through different channels, and conflating them risks obscuring the distinct mechanism under examination. Understanding that distinction requires stepping back from crisis imagery and examining the ordinary structure of deposits before stress emerges. Most depositors assume their money remains segregated within vaults or digital equivalents, yet banking law defines deposits as liabilities owed by the institution. Such liabilities form part of the bank's capital stack, which means they absorb losses only after equity and subordinated debt are exhausted. However, that hierarchy becomes operational only when resolution authorities intervene, transforming theoretical order into applied restructuring. Before any bail-in occurs, deposits already function as funding within a fractional reserve framework that allocates a portion to loans and investments. This arrangement enables economic activity while simultaneously creating maturity mismatch. Since depositors expect liquidity even as assets remain long-term, historical banking panics often revolved around this mismatch, including the Argentine Corralito of 2001, where withdrawal restrictions preceded broader financial restructuring. Yet the Argentine episode relied heavily on capital controls rather than formal liability conversion, illustrating that restriction alone does not constitute a bail-in. Resolution hierarchies determine when conversion becomes necessary, and those hierarchies place shareholders first in line for loss absorption. Bondholders follow, reflecting their explicit acceptance of credit risk. Although market complexity sometimes blurs distinctions between senior and subordinated instruments, depositors typically occupy a protected position through insurance schemes. But protection carries thresholds that quietly define vulnerability. During the Cyprus banking crisis, deposits above insured limits were converted into equity, effectively transforming savers into recapitalization participants. The conversion reflected regulatory logic rather than improvisation, because authorities sought to stabilize institutions without transferring losses to taxpayers. European policymakers subsequently codified that logic through the Bank Recovery and Resolution Directive, embedding bail-in as a standardized tool across member states. The directive formalized procedural steps that once appeared exceptional, which alters expectations even in jurisdictions where no bail-in has occurred. Financial forensics, studying past system failures to understand what survives, reveals that legal preparation often precedes public awareness by years. However, legal readiness does not guarantee application, and many banking stresses resolve through liquidity support rather than balance sheet restructuring. Still, the existence of a mechanism changes depositor incentives subtly, even when activation remains unlikely. Behavioral responses become visible once signals emerge, often beginning with denial shaped by deposit, insurance narratives, and institutional reassurances. In Lebanon, early withdrawal limits were framed as temporary liquidity management, allowing depositors to maintain confidence despite growing restrictions. Gradually, limits hardened into informal bail-ins through forced currency conversions and differentiated withdrawal rates, demonstrating how resolution can unfold without explicit declaration. This ambiguity complicates depositor interpretation because the absence of formal announcement delays recognition of structural change. A weekend resolution, by contrast, concentrates change into a defined moment that authorities can manage operationally. Timing allows regulators to freeze mobility, assess balance sheets, and communicate outcomes before markets reopen, which contains contagion at the cost of depositor agency. Yet containment also depends on compliance, and compliance arises partly from the expectation that restrictions remain temporary. The reopening of banks after resolution often preserves account visibility, creating continuity that masks underlying balances appear unchanged, except for access conditions, a design choice that reduces immediate panic while embedding new limitations. Still, visibility cannot fully suppress uncertainty, especially when depositors encounter unexpected withdrawal caps or conversion notices. Once restrictions surface, psychological progression begins to interact with procedural mechanics in ways that shape crisis dynamics. Denial frequently gives way to containment illusion, as depositors interpret insurance thresholds as guarantees rather than conditional protections. Historical precedents reinforce that belief, including smaller European bank restructurings where insured deposits remained intact. Although such outcomes depended on scale and fiscal capacity, modern parallels reveal how containment narratives persist, even amid contradictory signals, particularly when authorities emphasize systemic stability over individual impact. Eventually, restriction becomes normalization, and withdrawal limits framed as temporary evolve into enduring features of the financial landscape. Litigation pathways rarely reverse that evolution because emergency legislation grants authorities broad discretion during resolution. Cyprus depositors pursued legal challenges following equity conversion, yet outcomes largely upheld regulatory authority, illustrating the limited recourse available once restructuring completes. Normalization creates a long tail of adjustment, during which converted equity may recover value, but seldom restores depositor expectations of liquidity. Amnesia follows, not as collective forgetfulness, but as gradual acceptance of revised norms that reshape future behavior. The mechanism does not require public approval, only sufficient compliance to prevent systemic rupture. What consistently fails first, under bail-in conditions, is not liquidity alone, but the assumption that depositors exist outside the risk hierarchy. Historically, deposit insurance expanded after banking crises to rebuild trust, including the United States reforms of the 1930s that reframed depositor protection as a public good. However, insurance schemes operate within fiscal constraints, meaning that large-scale crises can exceed their capacity without broader support. Recent global signals suggest a quiet recalibration of that balance, as policymakers emphasize taxpayer protection and market discipline in resolution planning. The shift does not eliminate depositor safety, but introduces conditionality that becomes visible only during stress. Applying the lifeboat lottery framework clarifies this dynamic without reducing complexity to metaphor alone. Depositors expect life jackets designed for individual survival, yet resolution frameworks may redistribute those resources to preserve vessel integrity. The analogy risks oversimplification because financial claims lack the immediacy of physical survival. But the tension between individual entitlement and collective stability remains structurally similar. Present banking systems exhibit stronger capitalization and oversight compared to past decades, which reduces the probability of bail-ins while not eliminating their possibility. Stress testing and regulatory buffers function as preventive measures. Although their effectiveness depends on assumptions that may not hold under extreme scenarios, within that uncertainty, depositor positioning becomes less about prediction and more about understanding contractual reality. Returning to the quiet Sunday scene in Nicosia reveals how procedural calm can coexist with structural transformation. The ATM limit was not merely a liquidity control but an operational boundary marking the transition from depositor as client to depositor as participant in recapitalization. Seen through that lens, the absence of overt seizure does not imply continuity of ownership in its original form. Bail-ins operate by preserving institutions while redistributing losses internally, allowing systems to continue functioning even as individual expectations adjust. The quietness of the process reflects design rather than accident, because administrative containment reduces contagion while enabling balance sheet repair. Depositors standing outside closed bank doors encountered not the disappearance of funds but the redefinition of claims, a distinction that becomes clear only after the weekend interval ends. Understanding that distinction reframes the opening scene from a moment of inconvenience into a procedural turning point within the financial architecture that underlies everyday banking relationships. Reopening Monday morning rarely brings visible collapse, which complicates depositor interpretation of what has changed. Instead of empty accounts, individuals encounter adjusted balances, restricted transfers, or newly issued equity that replaces a portion of what once appeared as cash. During the Cyprus restructuring, equity conversion functioned as a recapitalization mechanism that allowed banks to reopen without immediate taxpayer funding. However, the presence of equity did not restore depositor liquidity, and the distinction between solvency and access became operationally significant. Modern banking interfaces reinforce continuity by displaying account values even when mobility is constrained, creating a perception of preservation that masks functional loss. Lebanon's experience illustrated this dynamic through differentiated withdrawal rates that quietly imposed losses via exchange mechanisms rather than explicit haircut announcements. That informal approach blurred the line between bail-in and capital control, revealing how procedural ambiguity can soften resistance while still achieving balance sheet adjustment. Yet ambiguity carries limits because prolonged restriction erodes trust and shifts depositor behavior in ways that can outlast the crisis itself. In many cases, converted equity underperforms expectations, reflecting the reality that recapitalized banks often operate in weakened economic environments. Legal recourse rarely alters that outcome, as courts tend to defer to emergency authority granted during systemic crises. This long tail of normalization shapes future depositor expectations, though the memory of mechanics fades faster than the memory of inconvenience. A contrast emerges when examining what tends to fail first across different resolution scenarios. Short-term liquidity instruments lose mobility before nominal value disappears, while longer-term claims may retain theoretical worth despite illiquidity. Historical parallels appear in smaller European cooperative bank restructurings where subordinated instruments absorbed losses quietly, leaving depositors relatively untouched. However, scaling those precedents to systemic crises introduces constraints, since widespread loss absorption requires broader participation across the liability structure. Current regulatory discourse emphasizes preparedness through resolution planning, living wills, and bail-enabled debt issuance designed to buffer depositor exposure. Still, such buffers rely on market absorption capacity that may weaken during synchronized stress events. The presence of planning does not guarantee depositor insulation, particularly when asset quality deteriorates faster than anticipated. Global banking systems now operate within a regulatory environment shaped by post-crisis reforms that prioritize internal loss absorption over external rescue. The bank recovery and resolution. Directive exemplifies this shift by mandating that institutions maintain sufficient liabilities capable of conversion during distress. While the directive aims to reduce taxpayer exposure, its existence subtly alters the depositor-bank relationship by formalizing participation within the resolution hierarchy. Recent supervisory exercises highlight that many institutions meet bail-in capacity requirements, yet these assessments depend on modeled scenarios rather than lived crises. Stress models rarely capture behavioral responses, including deposit flight triggered by early signals of institutional weakness. That behavioral dimension complicates resolution planning because mobility itself can accelerate the need for restructuring. Digital banking intensifies this dynamic, enabling rapid transfer of funds that compresses the window available for orderly intervention. Authorities respond through communication strategies and contingency planning, though such measures depend on depositor confidence that restrictions remain exceptional. Present signals across financial systems reveal an emphasis on liquidity buffers, deposit insurance coordination, and cross-border resolution cooperation. These measures strengthen resilience, but do not remove the contractual reality that deposits remain liabilities within institutional balance sheets. Understanding that structure does not imply imminent bail-in scenarios, yet it reframes depositor positioning as contingent rather than absolute. Practical synthesis emerges not from prediction, but from observing how systems prioritize continuity. Bail-ins represent one pathway through which institutions can survive stress while redistributing losses internally, preserving operational capacity even as individual claims adjust. The mechanism's quietness reflects policy design that favors administrative containment over visible disruption. Returning to the lifeboat lottery framework clarifies the trade-off embedded in that design. Passengers expect individual flotation devices, yet systemic survival may require reallocating those devices to stabilize the vessel itself. The analogy reaches its limits because financial systems allow for recovery and adaptation beyond the immediacy of physical survival, though the redistribution logic remains relevant. Depositors in Nicosia standing before ATMs did not witness confiscation in a traditional sense, but they experienced a procedural shift that redefined access, hierarchy, and expectation. Through the lens of financial forensics, that moment illustrates how continuity can coexist with transformation. The closed bank doors marked not the disappearance of deposits, but the activation of a framework prepared long before the crisis became visible, seen retrospectively. The weekend interval functioned as the operational bridge between contractual promise and systemic necessity. What began as a routine interaction with an ATM revealed the structural truth that deposits exist within a hierarchy designed to absorb shock. That realization does not negate the utility of banking systems, nor does it predict their failure. Yet it reframes the nature of depositor security. The scene returns to stillness as banks reopen and daily routines resume, leaving behind a subtle adjustment in how claims relate to institutional survival. Understanding bail-ins through that adjustment reveals them as mechanisms of continuity rather than rupture, processes that preserve financial architecture while quietly redefining individual participation within it.